We backtested working capital efficiency on 14 exchanges over 25 years using market-on-close next-day execution. The U.S. portfolio returned 11.07% compound annual growth rate versus 7.64% for the S&P 500. That's a solid edge on its own. But the down capture ratio of 13% is the real story. When the S&P 500 lost $1, this portfolio lost 13 cents. India pushed the compound annual growth rate to 15.15% with the same screen, beating the Sensex by 2.82% per year. The universe is all U.S. stocks above $500 million market cap with positive revenue and positive working capital. The signal is working capital divided by revenue, sorted ascending. Companies that tie up the least working capital per dollar of revenue rank highest. Quality filters layer on top, return on equity above 8%, operating margin above 10%, and positive year-over-year revenue growth. These remove companies that appear efficient because they're failing, not because they run lean operations. Without these gates, the screen picks up distressed companies stretching payables while the core business deteriorates. A company delaying supplier payments to conserve cash shows low working capital in the numbers, but it's weakness, not strength. The top 30 stocks by lowest working capital to revenue ratio form the portfolio, equal weight, rebalanced annually in June using market-on-close next-day execution. That means the signal is computed from prior close data, and trades execute at the current day's close. No same-bar entry. Equal weighting ensures the signal drives returns, not one lucky large position. June timing gives companies with December fiscal years a comfortable filing buffer. Most annual reports land by March or April, and a 90-day lag from fiscal year end prevents look-ahead bias from late filers. Transaction costs are 0.15% per side. Annual rebalancing keeps turnover low, typically 40 to 60% per year, which limits the drag from transaction costs. The hypothesis connects to Sloan's 1996 accrual anomaly. Companies that convert revenue to cash without bloating receivables and inventory tend to produce more persistent earnings. Working capital efficiency captures this through the balance sheet directly. Richardson, Sloan, Solomon, and Tuna in 2005 decomposed accruals and found the least reliable components, those driven by working capital changes like receivables and inventory. Predict returns most strongly. Our screen doesn't replicate the academic decile sort. It applies absolute quality thresholds and takes the top 30. Trading breadth for precision. The original Sloan spread was roughly 10% per year. Post-publication compression, documented by Green, Hand, and Solomon in 2011, eroded that substantially. Their paper found the hedge returns were no longer reliably positive by the 2000. The anomaly persists because many institutional investors don't track accruals or working capital quality. The signal requires accountant expertise most retail investors lack, and the short side is difficult to implement. With quality filters and a large cap floor, the realistic expectation is a 2 to 5% annual edge with improved risk characteristics. Here are the U.S. numbers from 2000 to 2025. $10,000 invested in 2000 grew to roughly $138,100 versus $62,900 for the S&P 500. The excess compound annual growth rate of 3.44% per year is meaningful over 25 years. But the capture ratio asymmetry is where this screen earns its keep. 13% down capture with 106% up capture means you're getting full participation in rallies while absorbing barely a tenth of the damage during sell-offs. The portfolio ran a beta of 0.726, which explains part of that defensive tilt. These are quality companies with stable cash flows, not high beta growth bets. That's the mathematical edge. Capture every dollar gained and lose only 13 cents of every dollar lost, and compounding does the rest over 25 years. The dot-com bust was the strategy's finest stretch. In 2000, the portfolio returned plus 18.5% versus negative 12.9% for SPY, a 31.4 percentage point gap. In 2001, negative 0.6% versus negative 17.0%, adding 16.4 points. In 2002, plus 5.8% versus negative 5.1%, another 11.0 points. 3 consecutive years of outperformance while the broad market lost nearly half its value. These companies had real cash backing their earnings. No revenue recognition games, no eyeball metrics, no burn rate narratives. The market punished the pretenders and rewarded the operators. The worst stretch came during the late 2010 momentum run. In 2019, the portfolio trailed SPY by 16.8 percentage points. Mega cap tech drove the index, and working capital efficiency had zero relevance to price action. When investors chase growth at any cost, a quality screen that rewards lean operations simply gets ignored. Globally, the same screen ran on 13 other exchanges. 10 of 14 exchanges beat their local benchmark. India returned 15.15% compound annual growth rate with 2.82% excess over the Sensex. Sweden delivered the strongest excess return at 6.51% over the OMX 30 with a 76% win rate. The US produced the best Sharpe ratio at 0.614. Canada had the lowest maximum drawdown at just -21.0%. The common thread is deep, diversified markets where multiple sectors contribute to the index, giving the efficiency signal room to differentiate. The pattern across markets is consistent. Working capital efficiency works in diversified economies with transparent accounting standards. It struggles in markets dominated by a single sector where one industry's characteristics overwhelm the signal. The strategy thrives in stable, earnings-focused markets. Periods like 2003 to 2007 delivered steady, consistent edges. Nothing spectacular in any single year, but the kind of reliable outperformance that compounds into meaningful returns over a full cycle. Post-accounting scandal environments were even stronger. After Enron and WorldCom, investors shifted attention to balance sheet quality and cash flow verification. When the market starts asking, are these earnings real? Companies with lean working capital and strong cash conversion stand out. Flight to quality is this strategy's tailwind. It struggles during speculation and momentum phases. In 2020 and 2021, the market rewarded companies growing at any cost. Inventory buildups, receivable surges, and aggressive revenue recognition didn't hurt stock prices because investors focused on growth narratives. The 48% annual win rate means roughly 13 of 25 years trailed the S&P 500. Running this strategy requires accepting multi-year stretches of underperformance. The alpha comes from not losing as much during drawdowns, and that advantage compounds quietly rather than producing dramatic annual outperformance. Patience is the price of admission. The inventory buildup trap is a specific blind spot worth understanding. Sometimes inventory buildups are rational. A semiconductor company anticipating strong demand will build inventory, pushing working capital up and looking less efficient on paper. If demand materializes, the stock does well despite the screen penalizing it. This is most common in cyclical industries with long production lead times where inefficiency is actually forward-looking preparation. The accrual anomaly is real and persistent, but the magnitude is smaller than Sloan's original 10% decile spread. Quality filters reduce exposure to extreme names, and 3 decades of hedge fund attention have compressed the standalone premium. The screen naturally overweights asset-light businesses like tech and services. If those sectors underperform for structural reasons, this portfolio underperforms too. Sector-neutral construction would reduce that tilt but also weaken the signal. Excluding negative working capital is a practical compromise. Apple, Amazon, and Costco all run negative working capital, which is a sign of operational excellence, but including negative values creates sorting problems that distort the signal. Working capital also fluctuates within the year, and companies with non-December fiscal years may show systematically different ratios at their reporting dates. Annual data smooths most of this, but the noise is real. That's what the data shows across 14 exchanges and 25 years. Full results, charts, and the backtest code are on the blog at cetaresearch.com. Link in the description. Working capital efficiency works best as a quality overlay on top of other signals, not as a standalone system. The code is open source at github.com/cetaresearch/backtests. Subscribe for more backtested strategies every week.